Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive right in, take a look, see what's going on today. If you want to follow me, it's at Financial Finance, and if you want to join our community, finding-value.com, where I dive into all these different sectors looking for investment opportunities and sharing those opportunities with everyone in the community. We do have a special going on. Special is a coupon code you can use on both the monthly and yearly memberships. You get 50% off the first month only. It ends up being $25 for that first month. Or you can sign up to the yearly membership, get a $100 discount, which ends up being $500 for the entire year. And you could also, if you wanted to, use the special coupon code on the monthly, try it out, and then sign up for the yearly if you enjoy it. All right, so coming down here, Lucas says, quick reminder, historically, the current PE ratio has coincided with a decade of lost returns. This time won't be any different. And that's based off valuations. And you know what valuations tell us? Where we're at in the cycle. And then you know what you're going to see? You're going to see platinum outperform the S&P. You're going to see gold outperform the S&P and the Dow Jones and all these different things. And that's exactly what we're seeing. All of the low price to earnings or price to book ratios are found in commodities. All the expensive stuff is found in the S&P 500 and financial assets. The cycle is all there. All the pieces of the puzzle have fallen in the right places, and we can read what this map is of that puzzle, which is good. R squared value of 79%, that's actually pretty high. That's really high, in fact, um, for a lot of the data that you try to correlate and match. Here's another one from Lucas. He says, oil bearishness is reaching ridiculous levels. Hedge funds are now more short oil than in 2020 when prices went negative. Ironically, that was the perfect time to buy. Oil outperformed every major asset for 2 years straight. They will miss this rally as well. And there it is, way down there in shorting territory, net short for oil futures contracts. Yeah, I mean, I don't get too. There's a lot of things that I don't really worry about. A lot of people look at these things, they have all this data. I don't know if a lot of the data really means much. I mean, what people are trying to do, if you're short term trading, they'll say, when is this going to go up? Let me rephrase what they're asking. They're asking, when are other people going to buy my stock? And if you think of it that way, does anyone really know that answer? When are other people going to buy my stock and have it go up? It's kind of ridiculous if you think about it. So then the technical traders, what they do is they'll look at the charts. They'll look at chart. And in the short term, it is really difficult. Your success rate is much lower than it is if you're tying in the longer term trend. So if you're really good, what you do is you're looking for setups that tie in long term, medium term, and short term trends. And you want all of them to align to go long or short. So you kind of want like this big top being put in at the same time that the medium is turning, at the same time that the short term market sentiment is good and going to get way worse. So you kind of want like all of that in alignment if you're going to short something. If you're going long, you want everything to be bottoming out, long term, medium term, and short term. And that could be like, decades upon decades is long term, medium terms like the 5 to 10 year time frame, and then really short term is like a year, like the yearly candlestick, daily candlesticks is that you're looking for a potential turn. And then you can even go even deeper and do like a short term where you're looking at it on an hourly or minute basis. And then that's how you would time your entry if you're trying to trade. It's you take a big picture view, dive in, smaller view, dive in, smaller view, dive in, smaller view, and then you get your entry point. But the short term and not in getting the short term right is your least percent success rate. That's why people are not very successful trading in the short term. They're very poor, and most people, what happens is they blow up. They blow up trying to trade the short term. So what I've adopted, and this is kind of what I'm naturally migrated to, is I try to exploit the the difference between short-term traders and market sentiment with my long-term big trend line market cycles. So if I see a bottom, I don't worry myself about the short term because you can't really time it. So I don't get in there and try to time it as best as I possibly ever can. I just get real close, I cost average in, and then I let it ride for the big trend. And if I'm getting these right, your returns are many, many fold. Not like 2x, 3x, 4x. We're talking 10x, 40x, 50x, maybe even 1,000x is possible, depending on if you get the right sector at the right time and the right company. There's a lot of things that have to align and a lot of luck involved to pull off 1,000 bagger in a 10 or 20-year period. So yeah, everything's really bearish in oil right now. Here's Jim. He says we're right 50.75% of the time, but we're 100% right 50.75% of the time. Mercer told a friend. You can make billions that way, says Jim Simmons. So what does that mean? So what he's doing is he's saying he's better than 50%, but when he wins, he's up massively. He's up 100% when he wins that amount. So you can lose and take a lot of small losses, but as long as asymmetry is carrying you, that's how you win in the portfolio. So I think one problem that a lot of people have is they worry about their positions. They worry. So let's say something's down 30%. They bought it, it goes down 30%. And let's say it's one of 10% that are down in the portfolio. So you've got 10% of your positions that you put on in the beginning go down. And let's say like 80 or 90% plus are going up, right? So they worry about the one that's down. They're like, oh, what should I do? Should I sell it? Should I move it? If your asymmetry is so big, you don't need to worry about it. You're worrying about something that you shouldn't be worrying about. And if time allows, so let's say you're down 30% in a couple month period, what if that really comes back and you win many, many fold above it? What if it's a 10x in 5 or 10 years? You just have to be patient enough for it to wait it out. So what I see is a huge problem is people are very impatient. They want to cut losses as soon as a loss brings itself to the front. And they'll say, well, cut your losers. It's like, dude, it's only been 1 week. In a week, it's not a loss. You just entered the position. They have absolutely no confidence, no conviction. They may not even know a single thing about the company. And of course, when you see a small down move, you're going to want to sell it because you know nothing about the company and how good it is. Now, what if you know a whole bunch about the company? This is what I would do. I've had positions go down 50, 60% on me. I mistimed it. Okay, it happens every once in a while. I bought a whole bunch more. And then I ride. And as weird as it is, the success rate we've had, myself and on the website, it's been pretty good. I mean, we've had many 100+% gainers in less than a year. Many. They're all over the place. And I'm changing, hopefully, mindsets on how to invest because some of them are up 6, 7, 800%. Some of them are speculative. Some of them are cash flowing companies. And we're at the beginning of this bull market. The money's made in the sitting. It's made in the waiting. And yeah, you do have to wait for opportunities to align. Like I said, the long-term, short-term, medium-term all aligning. But you can have a watch list of 100 companies, and usually there's something good, very good, at most times out there. So certain sectors get really good, other sectors move on up and they become less desirable, and then other sectors pull back and they give you good entry points again. But asymmetry is huge. And if you're asymmetry and you set up the portfolio correctly and your portfolio allocations are spot on or close to spot on, you should make a whole bunch of money, even if 5 or 10% of the portfolio kind of SHITs the bed, if you know what I mean. And you're going to have some that do that, no matter what you do. Bullish trend, tip of the day. Don't waste your time with oil price predictions. Nobody really knows where it's headed. It all depends on OPEC, the producers, and economic growth. The rest is just nonsense. The cure for low prices is low prices. I totally agree with that. A lot of people trying to make predictions. JP Morgan, I've been seeing these predictions from JP Morgan floating around. They have two predictions that they made, and they're like a year or two apart. Now they're saying, oh, oil's going to go to like $30 plus, 30 something dollars a barrel. And just recently before that, they were like, oil could get up to like $380 a barrel. It's like, that's a big discrepancy there, buddy. What I do, and what I think is the most productive way to do this for an approach, is go by value. Go buy where the value is, and then sit, wait, and be patient. Don't worry about the price predictions. Everyone is making all these predictions, left, right, up, down, $300 a barrel, $30 a barrel. And then people get afraid. They get afraid, oh, what if a recession comes? What if this? Here's some things that I'll state. I don't see a lot of recessionary, I don't see things looking that bad in the charts. The equities are outperforming oil itself, and that usually occurs during bull markets. Bear markets, the exact opposite. Bear markets, like oil remains resilient, but the equities just start selling off like mad. That's what a bear market looks like. A bull market is when the equities are being resilient and your price is low, and they don't want to fall. It doesn't mean they can't fall for a period of time, but that's what a bull market looks like because people are positioning in the equities. So don't get too wrapped up in the predictions. Don't get too wrapped in the predictions. I was reading Twitter here. One of the predictions that that Melody girl wrote was that house prices are going to fall 50%. And I didn't even listen to the video. It's like I don't need to hear anything because there's nothing there that she's going to say that she's going to change my opinion on. But I think she's exactly wrong. I think house prices are going to go up. And I know that's weird, but that's what the charts suggest in home builders. I think we're going to go through a slowdown, which we did. And then I think we're going to break much higher on the longer term. House price is going to go up, not down. And it deals with supply, demand, and money printing. And I think that's what's coming, what's in store for us. This is ACO natural gas. Look at the price move in ACO going up. $2 here, and then we're up around $2.50, and now we're up over $3. November 24, 25. That's looking pretty good. I think natural gas up in Canada is completely mispriced. Completely mispriced. I bought Canadian Natural Gas Company in 2020. The company, if you want to look it up, is Crew Energy. Crew Energy had a gigantic plot of land in the Montney that they could drill. Bought it when it was really, really cheap. I did well, I don't know, it was like a 15 bagger or something like that. And then it was bought out by another company. It had a 75% premium. And now we're going to start to see this natural gas, I think, come into effect. I think we're going to put in a lot of LNG takeaway capacity. We're going to put in a bunch of artificial intelligence data centers. Demand's going to go way up. And I'm not 100% sure that American natural gas can fulfill all that demand. I am not 100% sure. I mean, it's gigantic growth between now and 2030. So I think Canadian natural gas is going to have to step in, and that's the opportunity. That is the opportunity. And these prices are going to go up, 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 up. They're also going to put LNG takeaway capacity in as well. Coming down, Brandon Balo. He says, long-term copper chart trying to break out of a 4-year inverse shoulder head shoulder pattern. Will be interesting to see where November, December bars shake out. We're right up against resistance here. I've shown that fractal before where NVIDIA had the same 3-hump consolidation and then another consolidation just like this before it just started ripping. I'm in the camp that this is going to go higher. It's going to go much higher. So that's kind of where my head's at. We're right there trying to break out. We've got deficits out in the future from 2026 onward. I really can't see how this doesn't move unless we get some sort of recession. Now, when people say, well, what if a recession comes? You got to see it in the positioning in the charts. And with copper trying to break to the upside here, that's not exactly positioning for a recession. So when people pull the recession card, like, what if a recession comes? It's like, well, is that what we're seeing? What evidence do we have in the charts? This is not exactly evidence of a recession. It's the exact opposite. This is actually evidence of the economy booming. And then usually when the data starts to show that things are bad, that's usually the bottom of the market, not the top. Good data, like very good data, but some underlying deterioration of leading indicators perhaps, that's tops of markets. Bottoms of markets is when the data looks really bad, but then there's these signs like copper trying to break out where maybe we're bottom. And I know that's kind of the opposite approach. You can also look at home builders. You can look at U.S. construction employment. Construction employment was up. And I think that got a lot of people confused. Home builders are looking more resilient recently, just the past day or two. So things could be turning. They could be. Now, I don't know for sure. I don't know the future. But the charts people are positioning in a way that tells me that we could be seeing the economy actually strengthen. And maybe the worst is being priced in either directly behind us or right now. And people are starting position for a recovery, so to speak. Global inventories typically bottom early of October and rise seasonally. The 5-year average, plus 17 million barrels. What about this year after OPEC plus surge? A modest 35 million barrels. We're not bearish oil quite yet, but the level of bearishness is not being justified so far in the data. And there's the inventories coming up, but that's normal for most years. It comes up during this time of year. We come off the back end of summer driving season, demand dips a little bit, supply goes up a little bit, and inventories go up a little bit. So it doesn't look that bad at the moment for oil. Here's another thing, just to give you guys another piece of information to chew on. OPEC generally releases barrels into the market when there is demand for it. So when they release it back into the market, they think that the economy is strong. So we can look at copper trying to break out to the upside, but OPEC also is releasing barrels back into the market. They don't do that into recessions. They do that into economic strength. And maybe the economic strength is found in China. Remember, China went through that deflationary bust in 2020? It takes about 5 years for that to bottom. And where are we at 5 years from now? We're going to be entering a recovery phase and real estate cycle for China. So that's going to be good, and this could raise demand for all these different commodities, which is a good thing. Where are gold and silver on this chart here? If I were to guess, and I know I'm going to sound crazy here, I think we are in the stealth phase to awareness phase. Yep, I know. Like we're over here. We're in the takeoff. See where it says takeoff? Like we're in this area over here coming on up. And I think we're going to enter a bull market with interest rates going up. And the way I think of it is it's because of where interest rates are at. Now, interest rates took off. They hit the first sell-off, and we're going to put in a bear trap for interest rates. So I think that we are somewhere in this range here for takeoff to first sell-off to bear trap for interest rates. And interest rates are the driver of silver going up. So that's where I think. I think we're in the institutional investors and we're in this awareness phase, and that's where we're at. Right there. Interest rates, silver, and gold. Then we have all this to go. And then we're going to have to see financial assets slow down, roll over, go sideways. That is also, they're up here. Like they're in the greed, delusion, new paradigm phase where their valuations are sky high. So I think this has to go down for like 8 or 10 years or more. And then this is going to go up for 8 or 10 years or more. So that's where I think we're at. And it's solely based off of I can give you one example on silver. So let's do this real quick. XAG, USD, go big picture view. Do the line so you guys can see it, and then I'm going to take this away. So if you were to do kind of this flat, like look at it as such here. So I would do something like this. There's that. We've got this big bottom here. So I think that we are potentially, could be, that is that. Maybe. You could also argue because of interest rates that I didn't draw that line correctly. So if you take the US 10-year and put it underneath and you break the interest rate barrier here, we'll just do it like this. And then and put a vertical line on here. So vertical line, and then right where this kind of breakout is, that is where this is here. So that cross is where this cross is here. And I could see that being a possibility. So if someone were to say, well, what's left in this bull market? I would say, well, we could take this and I'm just going to throw it on top. So that is where it started on that line here. So that is kind of where it is. We get a price of like $350 and it's out in 2047. 2047. Now that could go quicker. It could go quicker. It may not. I don't know. But that I'm basing it off of interest rates. When this broke out, silver really took off. And then it peaked. And then that peaked there and headed lower. So that's what I think is coming. And that's where I think we're located. We have a long way to go. Oil is now as cheap as it was before every major price explosion of the last 30 years. And almost nobody is talking about it. Divide that. We already did that. It says oil tripled, oil surged from that to that, oil doubled here, and then oil exploded from 17 to 108. So these are the 3 or 4 times in history that it's occurred. Patterns never failed. I already went through a lot of this, so I'm not going to go through that again. So that's where I'm going to end it, guys. That's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Special coupon code. And we'll catch you next time, guys. See ya.